All right, let's talk about Seacoast Banking. They just dropped a Q2 earnings report that was, frankly, a blockbuster. I mean, they blew past what all the analysts were expecting. But here's the weird part. The stock barely moved. So what is going on? Let's dive into this debrief and figure out what the real story is for SBCF. Here's how we're going to break it all down. First, we'll hit those headline numbers and that puzzling market reaction. Then, we're going to look under the hood at the margin expansion. That's the real engine here. After that, we'll talk about their M&A strategy, unpack what management is planning, and then wrap it all up with our take on what to look for next quarter.
So let's start with the numbers, because on the surface, everything looked fantastic. This was what we call a clean beat, meaning they outperformed expectations pretty much everywhere you looked.
Okay, check this out. Adjusted earnings per share came in at 52 cents. The street was looking for 42 cents. That's not just a little beat, that is a massive, almost 24% surprise. A number like that, well, it definitely gets your attention.
And it wasn't just some accounting trick on the earnings line. The top-line revenue was also really strong. They pulled in over $151 million, beating the consensus by more than 4%. So you've got strength from top to bottom, which is exactly what you want to see. But this is where the story gets strange. You see a beat this big, you expect the stock to take off, right? And it tried. It popped almost 4% during the day, but then all those gains just melted away, and it closed pretty much flat. So that tells you the market is looking past these great numbers and is worried about something else.
To really get what's happening here, we have to dig a little deeper. So let's get into the why behind this quarter's amazing results. It really comes down to one thing: margin expansion. For any bank, you've got to understand the net interest margin, or NIM. It's the lifeblood of their business. Think of it as the simple difference between the interest they make on loans and the interest they have to pay out for deposits. When that number goes up, so do profits. It's that simple.
So how did Seacoast work their magic here? Well, they played both sides of the coin perfectly. First, they were super disciplined with their funding and actually managed to push their deposit costs down. At the same time, the yields they were getting on their loans ticked up. Less going out, more coming in. That's the recipe for a wider margin.
And you know, this didn't happen by accident. The CEO, Chuck Schaefer, said it himself on the call. This was all about disciplined execution. It shows they are running a really tight ship, growing their loan book while keeping a firm grip on costs. That's impressive.
But look, running a great core business is only half the picture for Seacoast. They have a second engine for growth, and it's a big one: M&A. This bank isn't just trying to get better. It's actively trying to get bigger and fast.
And when I say fast, I mean it. Just look at this timeline. They literally just closed their deal for Heartland in July, and they're smack in the middle of integrating it. But they're not stopping there. They're already getting ready to close another, even bigger acquisition, VBI, later this year. That is a ton to have on your plate at once.
Now, that VBI deal, that's the one you really need to watch. This is more than just buying assets. It's a brilliant strategic move. With VBI, Seacoast will instantly have a dominant market share. We're talking over 50% in the villages. That's an incredibly unique, wealthy, and concentrated market in Florida. This gives them a fortress of cheap, stable deposits to fund their growth for years to come.
Okay, so we've got a core business that's firing on all cylinders and a massive M&A pipeline. So what does the road ahead look like? Let's turn to what management told us, looking at both their official guidance and what came out in the Q&A with analysts.
And the outlook they gave is pretty confident. They expect that core NIM to stay strong, right around 3.35%. Plus, the acquisition should tack on another 10 basis points. They're also guiding for continued healthy loan growth and see no major issues with credit quality. All in all, it's a pretty rosy picture.
But there's always a but, isn't there? In the Q&A, the analysts dug into a potential problem. The really big national banks are starting to jump back into the Florida commercial real estate market. More competition means it's harder to get good pricing, and that could start squeezing those nice wide spreads they've been enjoying. That's definitely a risk to keep an eye on.
Okay, so let's put all the pieces together and land this plane. We've got the great results, the big M&A plans, and some potential storm clouds on the horizon. So what's our take on all this for the next call?
It all comes back to that central puzzle we started with. How can a company post such a fantastic quarter and see its stock basically go nowhere? Well, the market is sending a clear signal here. It's not about what you just did, it's about what you're going to do next.
So here's our thesis. The market is basically saying, hey, great quarter, but we're nervous. All that fantastic operational execution is being overshadowed by a big, flashing light, M&A integration risk. Can they actually digest these two huge deals at the same time? So the catalyst to get the stock moving is simple. A smooth VBI closing where they prove they can pull it off. The risk, any delay, any hiccup in that process. And for that reason, we're calling this a market perform. It's a classic show-me story. For the stock to really outperform, Seacoast has to prove it can execute on this ambitious plan.
This is not financial advice.